Welcome to Energy Unplugged, the go-to podcast on the global energy transition. My name is Hanns Koenig, and I'm Aurora's Managing Director for Central Europe. Today is a very special episode of Energy Unplugged for at least two reasons. Firstly, this episode is extremely topical and timely, given that we discuss the results of the European Hydrogen Bank auction, which were only announced last week, with one of its main designers, Johanna Schiele. Welcome, Johanna.
Hi, good to be with you.
Secondly, it is to my knowledge the first episode in which we host an Aurora alum. Johanna worked in our Berlin office for 2 years before doing graduate work at the Harvard Kennedy School and then joining the European Commission's General Directorate for Climate Action. So it's really great to have you back, at least on the pod, Johanna.
Yeah, it's excellent to be back.
We are also joined by my colleague, Emma Woodward. Emma is Aurora's European Hydrogen Market Lead. Hi, Emma.
Hello, great to be here.
Great, let's get going. And before we start talking about the results of the auction, let's give everyone who hasn't been following this as closely as the three of us perhaps have a quick intro. So, Johanna, can you tell our listeners what the European Hydrogen Bank is?
Yes, very happy to. So maybe a caveat right at the beginning. The European Hydrogen Bank is not a bank. It's a set of instruments that the European Commission has designed in order to kickstart the European hydrogen market, both in terms of domestic production, so production within the EU and the EEA countries, and also imports from countries outside of the EU into the EU. The Hydrogen Bank is an initiative that was first announced in von der Leyen's State of the Union speech in 2022. We have then adopted an official communication in March 2023, and since then DG Energy and DG CLIMA, two of the Commission's DGs responsible for this topic, are working together on implementing the European Hydrogen Bank. Now, what falls under the European Hydrogen Bank? There's two main legs. That includes the domestic market creation part, which is what we do at DG CLIMA with the auction that we're going to talk about today. But then there's also the question of imports and incentivizing foreign or outside of the EU imports, which is with DG Energy colleagues. And then there's a third part, which is overall transparency and coordination measures. How can we better coordinate existing funding instruments? How can we use the data that is created in this process, for example, to make demand assessments or to plan infrastructure better? So all of that falls under the umbrella of the European Hydrogen Bank.
Okay, great. Thanks a lot for that introduction. So let's double click on that first part, because that was also the part that you were very busy building over the past couple of years. So what was the design of the auctions?
Yes, so we tried to design an auction for the production of renewable hydrogen in Europe with four main objectives in mind. The first objective, and this has to be the objective of any subsidy, is to reduce the cost gap between renewable hydrogen production and fossil hydrogen production. So over time, this cost gap needs to come down, because for no good, it's possible to subsidize it forever. So long-term goal, subsidy need has to come down. Second objective is we want to contribute to price discovery and market formation for renewable hydrogen market in Europe. Hydrogen is not currently a traded commodity. There's no uniform and liquid reference price for hydrogen. So market creation will be really important as well for prices to come down. Third objective is we want to make sure that our tool is sufficient to de-risk these projects for private financing to come in. And the fourth objective is to reduce the administrative burdens for all applicants, but also for us as the public authority. And how did we try to achieve that? So the auction design in a nutshell, this is a pilot auction. It's the first attempt at this. We have a pilot budget of 800 million euros from the EU. The auction good is RFNBO, so renewable fuel of non-biological origin hydrogen. And we auction off support in the form of a fixed premium that will be provided over a period of 10 years. So that's euros per kilograms of hydrogen produced over 10 years. The bids are ranked on price, and there's a price ceiling at €4.50. So that's the maximum support you can ask for. There's also a maximum time to entry into operation, and this links closely with a feature that's pretty new for EU funding, which is a so-called completion bond. So we want to avoid speculative bids in the auction. We want to avoid that people bid speculatively low. And therefore, we've introduced something like a deposit. Like when you rent a flat, you have to put down a deposit to, well, to avoid wrecking the flat or not giving it back. The same is true here. We want to make sure that these projects actually achieve entry into operation and that the project development risk stays with the private sector, because the private sector is really much better at handling it than we are. So if projects don't reach entry into operation within 5 years, we retain this completion bond or deposit, and the deposit is 4% of the total subsidy volume. So it's not insubstantial. Maybe some last design aspects. The payments will be semi-annual, so projects will get paid every 6 months based on verified and certified actually produced RFNBO volumes. And a tricky question, or something that's always hard to explain, is what do projects actually bid into this auction? And the way we like to explain it is you have the levelized cost of hydrogen on the one hand, that's your production cost. And then you have a market revenue that these projects expect on the other hand. And between these two, there's a gap. And this gap is what projects should be bidding into the auction. It's the gap that they think they need to make the project financially viable between the cost that they have and the revenues that they expect.
Okay, great. Well, thank you very much for that overview. And we could probably spend hours discussing all the various aspects and how you came up with that. And well, sadly, we don't have that time. So just one follow-up on that. What would you say were the trickiest aspects to figure out when you were designing the auction?
Yeah, there were lots of them. Thankfully, we had some really good input from stakeholders as well. We ran quite a thorough stakeholder consultation process. And I think especially from project developers and from banks, we got a lot of good feedback into what can actually work for the market. I think the two trickiest choices were at the very beginning, what type of auction we should go for. So in the power sector, we obviously have a lot of CFD style auctions, so contracts for difference, where you pay a difference to a variable reference price. And from an economist's perspective, and I guess we're all economists here, a CFD is the more efficient type of auction in principle, because you don't have so much forecasting uncertainty. You only pay a variable difference to a reference price, and if that reference price goes up, you reduce the payments. We've opted not to do that. We went for a fixed premium auction instead. And the reason for that is really the stage at which the hydrogen market is at that point, and that we saw substantial differences to power markets and the liquidity and the maturity of power markets, for example. So we went for the simpler option at the beginning, fixed premium auction. But in the medium term, as the market forms, we are open to moving to a CFD style model. Second question probably has to be accumulation. That was really difficult, mostly because of what projects want versus what makes sense for a fresh start and a level playing field. So we don't allow for almost all forms of accumulation with other aid. This is because this auction can cover 100% of the funding gap. So any financial gap you have to make your project financially viable, you can bid it into the auction. If we were to allow accumulation with other public funding, we would really skew the level playing field of bidders in favor of bids from those countries where a lot of other public support is available. And that's something that we did not want, because it distorts price discovery in the auction. You're suddenly not competing anymore on the project financials and the project fundamentals. You're starting to compete on the generosity of the general subsidy situation. And here we really wanted a fresh start with this instrument, also because of this price discovery objective. But to say there's still the Innovation Fund regular grants, so projects that have received some funding in the past and they have not made it over the finish line to FID because project financials have changed, CapEx has increased, whatever, they can still bid into or submit an application to the Innovation Fund regular program.
Yeah, I expect that second part was particularly tricky, just because there's so many schemes that provide implicit or explicit support, from quota systems that create a demand and willingness to pay to exemptions from grid fees and these kind of things. Differentiating between all those and only taking the right ones into account probably must have been quite difficult.
Yes, it was indeed. But thankfully, we had really good help from DG Competition as well. And I think that cooperation has also led to this auctions as a service concept, which maybe we can speak about a little bit later. But it was really good cross-DG effort on this one.
Yeah. So before we go into the results of the hydrogen auction, the European hydrogen auction, let's talk a little bit about how the European Hydrogen Bank auctions design differs from other support auctions we've seen across Europe. Emma, would you like to take that one?
Yeah, that's a great question, Hanns. We've seen four main auction designs that are emerging, although of course there are complexities within these and they're not really cookie cutter models just yet. The first of these is the fixed premium model, which is really what Johanna has been describing to us, and was the model that was used in the EHB auctions, as well as in other auctions that we've seen across Europe, such as in the Denmark Power to X tender that finished at the end of last year. And the real advantage of this as a setup is that there's no market reference price needed, and it's probably relatively straightforward to implement compared to some of the other designs that we've seen emerging, although I'm very sure that Johanna might disagree with me for calling it straightforward to that extent. The other main design, though, that we've seen emerging, which we've already touched on a little bit as a potential future model, is the CFD scheme, or the contract for difference scheme. This has been most notably used so far in the GB hydrogen allocation rounds. So the first of these concluded at the end of 2023, and the second round bids had to be submitted in the middle of April last month. So under the CFD scheme, successful bidders will receive a payment based on the auction strike price relative to a reference price. And in GB, the reference price that's being used is the natural gas price. So if the strike price is higher than the reference price, the operators will receive a payout equivalent to the difference between those two prices. But if the reference price is higher than the strike price, so in the GB case, if the natural gas price exceeds the auction strike price at any point over the contract period, then any excess revenues that the developers are achieving will have to be paid back. And what this setup means is that developers have a very, very high level of certainty over the future revenues that they're going to achieve. And this has proved bankable in early renewable developments, which is really the reason why people are looking at it as a model. But it is, of course, potentially more complex to implement. The third scheme that we're seeing is for direct CapEx support, which is fairly straightforward as an upfront contribution to the very high CapEx cost that we're seeing for electrolyzers at the moment. And the fourth scheme is probably the most complicated, which is the double-sided auction setup, which is what we're seeing for H2 Global. And here, both buyers and sellers are bidding in for the prices that they need to see for both selling and buying hydrogen, and an intermediary will then fill the monetary gap that's required. The major advantage of this as a scheme is that supply and demand can be matched, but as we've said, it is probably the most complicated scheme that we've seen announced so far. And finally, some auctions, which includes the Netherlands scheme, which actually the results of which were also announced this week, use a combination of these setups. So in the Netherlands, there was both CapEx support available as well as CFDs that were sort of part of that scheme.
Great. Thanks a lot for that overview, Emma. Really, really helpful. So let's move over to results and back to you, Johanna. For those of you who haven't followed last week's announcement, can you summarize the outcomes of the auction for us?
Yes, very happy to. So we've been waiting for a couple of weeks to make this public, and it's really exciting. All of the information is now out. We tried to publish as much analysis as we could whilst respecting the commercial sensitivities of the projects that bid. So this is obviously striking a fine line, and I will try to also thread that line carefully today. We think this first pilot auction was a big success, mostly because we really had a great level of participation. 132 bids were received from 17 different EEA countries, and only 13 projects failed admissibility and eligibility criteria. So that's really a very good rate. Let me say right at the beginning that this is also a great example of how ETS resources can be spent. The money for this auction comes from the European emissions trading system, and the 720 million euros that were now awarded to 7 winners in this auction, they all came from ETS revenues. Now, you may wonder why we only spent 720 million euros when the initial auction budget was 800 million euros. This is because usually there's a marginal bid. So that's a bid just at the border of our budget, but it goes slightly beyond that. And this bid we could not award anymore. So the remainder, the 80 million euros that were unspent, they will just roll over back into the Innovation Fund budget and can be spent in future auction round. The clearing price of this auction, which is probably the information that most people have been waiting for, is 48 cents per kilogram of hydrogen produced. So that's the last awarded bid out of these 7 winners. And that's really quite encouraging in terms of the price level. It's quite low, and it shows the amount of participation that we've seen, but also just the benefits of running an auction EU-wide as opposed to in a smaller geography. Now let's talk a little bit about the winners. We have 7 winning bids. Together, they will produce around 1.6 million tons of hydrogen over 10 years. And that hydrogen comes from a common electrolyzer capacity of 1.5 gigawatts electric. And in a very conservative estimate of how much carbon these projects will be avoiding, it's 10.8 million tons over 10 years. And this only includes the avoided carbon from not producing gray hydrogen. It doesn't include the abatement of possible use cases of that hydrogen where additional fossil fuels are replaced. So it's really a conservative estimate of the carbon abatement that we can achieve with this auction.
Great stuff. Thanks a lot. Thanks a lot for that overview. Really, really helpful. So you already mentioned the 132 bids you received. So that's, I think, as things go, a pretty good level of competition. What were the main sectors that participated and that were successful in the auction?
Okay, so we have some data on the offtake sectors where the hydrogen is expected to be used. And I'm saying expected to be used because at the time of bidding, projects don't actually need to have signed offtake contracts yet. What they're providing us with is a memorandum of understanding or a letter of intent or some other pre-contractual document that shows their intention over 60% of the sales volumes. So digging a little bit into that data, we see that the majority of projects intends to sell to industry clients. 82 projects intend to sell to industry, whereas 37 projects intend to sell to mobility. And for some projects, they have not identified this data. We can dig a little bit deeper into the offtake sectors. And here I already want to make a little caveat. This is data that's indicated by the projects themselves. So sometimes the definitions overlap a little bit. On the industry side, we see that projects want to sell to the steel sector, to chemicals production, ammonia and fertilizer production. Then we have some methanol refining, but also just injection into pipeline infrastructure, and some use cases in the power sector, so electricity or heat generation, long duration storage through hydrogen, and lastly, industrial gases. On the mobility side, we see a lot of heavy duty transport, so heavy duty trucking, aviation, bus transport, ground transport, like forklifts, for example, but also delivery to hydrogen refueling stations where we will not know exactly where the hydrogen will end up.
Okay, very, very interesting. So that was among all the participants in the auction, correct?
Exactly.
Can you also talk about the winners? What were their offtake sectors?
So that's a slightly tricky question, which I can't answer today. For the winners, we try to strike a balance of keeping their commercial information secret unless they give us the permission to publish that data. So at the moment, the winners will enter into a grant agreement process with our executive agency. And once they have signed the contracts, we ask them for permission to make additional data public, such as the type of electrolyzer that was used in the winning bid or the offtake sector that they intend to deliver to. And this will then be part of a project fact sheet that's a bit more detailed once these projects have signed.
Okay. So we have to stay tuned about that. Makes sense. In general, I mean, I think one of the things that I found really helpful is the level of detail you really provided on the bits there, and you already touched upon it a little bit when talking about the sectors. Among all the other detailed results which you published, could you give us a couple of punchlines on what you found really striking or surprising about the bids?
Yes, very happy to. So maybe one encouraging thing at the beginning. At the moment, the problem in the hydrogen sector is that many projects have not reached FID and have not started production yet. There's a lot of projects on paper, but not that many that have moved beyond FID. And one piece of information that we found very interesting when looking at all the bids is that these projects can actually build quite fast. And there's a solid pipeline of projects that are ready to enter into operation fairly soon. So the median expected time to entry into operation across all bids is less than 3 years. We have set the maximum time to entry into operation to 5 years, but I think the auction results have encouraged us to go a little bit down on that, and that projects can actually build and start producing much quicker, despite all of the issues we still have with permitting, etc. So that was one of my highlights. Another one is on the electrolyzer technologies used. So we see mostly alkaline and PEM electrolyzers, roughly half-half between those two, but also some projects that combine alkaline and PEM. Now, first interesting point to note, there's no SOEC bids. This technology is a little bit more expensive and mostly integrated, makes sense when integrated with heat sources. So we see that in an auction based only on price, there were no SOEC bids. These projects are still eligible in the regular Innovation Fund grants, but we really see this as a price issue here.
Just to explain that to all our listeners who don't follow this every day, SOEC standing for solid oxide electrolyzer cells.
Yes, thanks, Hans. I'm clearly already too deep in the bubble. Second interesting point about the technology used is that we see that projects who combine alkaline and PEM electrolyzers, and maybe I'm also taking a step back here, on average, alkaline technology is slightly cheaper, but also slightly less flexible in terms of ramping to the profile of variable renewable production, whereas PEM tends to be slightly more expensive, but more flexible in terms of ramping capacities. And what's really nice to see is that projects that combine both and also have an intelligent dispatch software or really make use of both profiles of cheap and slightly more inflexible and more expensive and slightly more flexible, they show lower levelized cost of hydrogen on average than projects that just intend to use either or. So there could be an element of coincidence here because it's only 10 projects that combine both. But for us, that was a really interesting insight that also smart business models can influence the price. And then one very last one, which is maybe the most political one, where do these electrolyzers come from? So we don't have extremely detailed information in terms of the downstream of the electrolyzer components, but we have information of where the projects intend to procure the electrolyzers and where the company sits that will produce the electrolyzer. And I think what's quite encouraging here is that actually roughly half of the projects intend to procure European technology, and another quarter of projects wants to procure European plus some other technology. So that was very positive to see as well.
Okay, great. Thanks a lot. One of the things that I found really, really striking in all this data you released is that the transport sector reported generally higher expected offtake prices, which I think is pretty much in line with conventional wisdom, I would say. However, these projects generally still expect to receive more support from the premium than projects with offtake in industry, and therefore submitted higher median bids. Can you tell us what was going on there? Because that feels somewhat counterintuitive.
I fully agree. This was a surprise to see, and I'm not pretending that we've dug to the bottom of this question yet. But I think one element that plays in here is that for industrial off-takers, often the green hydrogen is immediately replacing gray hydrogen in some already existing process. And in many cases, these plants are integrated. So the production of the hydrogen, the use of the hydrogen is really close together. Whereas for mobility applications, the hydrogen usually needs to be transported somewhere where there's a fueling station. And pricing this additional transport cost into the bid, that could be one element that affects the slightly higher bid price for mobility. But also just the amount of projects that we've seen. I mean, there's 37 projects that have indicated a mobility off-taker. And it's also possible that this is simply not perfectly representative.
Makes sense. Thanks a lot. So let's zoom out again from the details of the results. Thanks a lot for releasing them again. I think you've really done the industry a big service there. And let's look at the overall outcome and the price, because obviously I think definitely a surprise on the low side, which is great, and in that regard a huge success. On the other hand, potentially also a bit of a risk, because for instance, if you take the case of offshore support auctions, which also have been very competitive and cleared very low in various countries, but then there have been a number of projects unable to deliver at the terms they initially offered, and then pulled out. Given this quite low support level that came out, is that a concern you have?
Yes, thanks. Really good question as well. I think first of all, I want to say that we're quite happy with the very competitive price level. It's really important to see that relatively low subsidies for hydrogen production are possible in Europe. But of course, I see the concern. What if projects simply cannot follow through at these prices? Well, we designed the auction quite purposefully in a way where the business risk, the business model risk, and the construction risk remains with the private sector. We have this completion guarantee. Projects have a strong financial incentive to reach entry into operation. Otherwise, not only do they receive no money from us, but they're also terminated and lose this completion guarantee. So we hope that this is a sufficient incentive to mean that the bid submitted will actually be followed through on.
Makes sense. Thanks a lot. I want to touch on one more thing you already mentioned earlier, and that is the auction as a service model, which is also something you introduced with this first auction. And Germany was the first member state to make use of that. Can you first explain to us how that worked, and then secondly, how it worked out in this first auction round?
Yes, very happy to. The idea behind auctions as a service is simply not to reinvent the wheel. We have an auction design for hydrogen now, and it makes sense that member states who want to provide national funds for hydrogen production can also make use of that model if they want to. So what we've done with auctions as a service is we've worked closely with DG Competition to make sure that the auction is perfectly state aid compatible in its design. And that also means that if member states want to provide national funds, which are usually state aid, and channel it through this auction, they can, and they can get relatively quick state aid clearance because this auction is state aid compatible. Germany was the first country to have made use of this. They blocked a budget of 350 million to award additional German projects on top of the project we can award from the European funds. And the German authorities have been passed on projects that we have evaluated and that are sort of next in the price ranking, but just from Germany. And it's now up to the BMWK, the ministry in Germany, to announce those results when they are ready.
Okay. So that's not out yet. Interesting. I mean, one of the things that I found interesting is that the bids in generally that came from Germany, you also published a ranking by market. They were substantially higher than in most other markets. Do you think that has something to do with the certainty of getting awarded in the second national auction for some of these projects, or is it simply that you just have higher costs in Germany because it's a more expensive place to produce green electricity?
I actually think the bids from Germany were, I don't want to say surprisingly low, but given the gap you would expect when just looking at power prices, which are a main component to production costs, I think the German submitted bids are actually quite competitive.
Yeah. Okay. Makes sense. Great. Thanks a lot for taking us through all that. And we could talk about plenty more, but we do have a limited amount of time. And I'd like to zoom out from the Commission take and go over to Emma, because I know that you and the Aurora Hydrogen team spent quite a bit of time modeling the auction outcomes. So from your perspective, what were the big surprises, and or to frame it a bit more provocatively, what did we get wrong and what did we get right when modeling the auction?
Yeah, again, I think that's a great question, and I think everyone was surprised by how low the results were, and we at Aurora are included within that. When we'd undertaken the modelling that you've referenced there, in our central case, we'd expected the price to come out more around 1.9 euros per kilogram. And even in the more competitive cases that we were looking at, we were modelling them at closer to 0.9 euros per kilogram, which is still almost twice as high as what the final prices were. And I think there's a couple of takeaways that we can pull out from that. In general, I think the ultimate thing that it implies to us is that project developers must be confident they can achieve a higher offtake price than we necessarily expected, and that the overall willingness to pay for renewable hydrogen is slightly higher than we'd been modelling. And I guess it comes back to Johanna's earlier point as well, is that many of these projects are relatively developed and ready to enter into development sooner than expected. So we're sort of seeing first production at closer to 3 years than the 5 years that they'd originally been allowed. And to us, the other thing that potentially implies is that some developers are, we're moving ahead with these projects anyway, and have taken the view that a level of support is sort of better than trying to achieve it with no support whatsoever, and the sort of the cost gap that was needed can be fulfilled at that relatively low price. I think what hasn't been a surprise is the countries where successful projects have been located. The clear winners here in the auction are Iberia and the Nordics, and that's really exactly what we were expecting to see, with both of these regions having a much higher availability of renewable power and also much lower costs. And that ultimately implies that they're the cheapest places to see hydrogen production, with substantially less of a cost gap between renewable hydrogen and grey hydrogen. And that's just a function of the power system in those regions. The only difference potentially that we saw was in the Netherlands, where we had also anticipated that there could be successful bids, but potentially that also comes into the fact that the Netherlands have had their own auctions, which I'm not saying were less competitive, but there were certainly fewer bidders, given that they weren't competing with the whole of Europe.
That makes sense. And actually, yeah, that's one of the things that slightly dropped in the news, because if I remember correctly, the Dutch results were announced the same day as the European Hydrogen Bank auction results. And obviously the European auction was much bigger. So yeah, well, actually, let's take that point and talk a bit more broadly about how recent auction outcomes have compared. So there's been the European auction, there's been the Dutch one, there's been the Danish one. So how do all these compare?
Yeah, again, another great question. And it is interesting to look at how the results are developing, because there's not, I would say, clear trends emerging. Like, the level of price support that we've seen across these auctions has been quite different. Within the Netherlands auctions, for people that haven't sort of read the results of that, as you've said, they have been quite overshadowed. There was about 250 million euros of support for a combined capacity of around 101 megawatts across 7 projects. And even that compares quite well to other auctions that we've seen in GB. The Har1 auction saw about £2 billion supporting 125 megawatts of capacity, whilst in Denmark, there's about 170 million euros supporting 280 megawatts, although some of that capacity has dropped out. We often do get asked about what the differences are between these results and why prices are coming out so differently in different countries. I think my first comment on that is that there are quite a lot of caveats between directly comparing these. As we've alluded to earlier, the auction designs aren't the same. And so whilst we can sort of put a number on that GB level of price support, if gas prices do increase, based on what the current reference is expected to be, that number will close quite substantially, whereas in other schemes, it's more of a fixed sort of price setup. So whilst you're making those direct comparisons, you do kind of need to keep that in mind. But I think the real difference between why we are seeing different levels of price support required in different countries really comes to the point you were thinking about in the German context, where like different countries do have quite different power networks, they have quite different availabilities of renewable power, and they have quite different cost bases. And so if you are looking to develop a hydrogen project in a country like GB, which is still relatively reliant on gas in the system, or in Germany, which again is relatively carbon intensive compared to countries like Denmark, first, it's harder to sort of secure the PPAs that you need. You can't directly plug your electrolyzer into the grid and still be able to meet those renewable targets. So the power sourcing strategies you're having to put together are necessarily more complicated, and you're paying more for power. The advantage, of course, with producing hydrogen in those countries is though that there are less sort of dependencies on transport and storage network. And so I think there's still sort of a little bit of a question in my mind around sort of how to ensure that we are also seeing and supporting developments in countries with higher carbon intensities on the grid. But I am very, very encouraged by what Johanna said about German projects needing less support than had originally been anticipated.
Makes sense. Thank you, Emma. I know you and the team have been supporting bidders into other auctions, such as the British Har ones as well. So, from the bidders' perspective, what are some of the key challenges that bidders are facing when they're placing their bids, and how can they be mitigated?
Yeah, I mean, there are a huge number of challenges when you're putting these projects together in all countries, and all the projects that we're talking about. They are first of a kind. And we could probably do a podcast in its own right, sort of looking at these challenges, which range from issues around securing off-takers and off-takers that are credit worthy and that banks are willing to finance projects against. There's issues around transport and storage of hydrogen and how to locate your electrolyzer so it has both access to renewable power, but is also able to ensure that hydrogen is delivered where it's needed. There's issues around water, land access, and in many countries, grid connections. But one of the major areas that we've really been focusing on is managing risks associated with power procurement and helping people think about what power procurement strategies can work. All of the auctions that we're looking at, bidders need to ensure that they're meeting either renewable hydrogen standards or our FMBO rules in Europe, and in GB it's the low carbon hydrogen standards which have to be met. And in both cases, that means that developers must be thinking very carefully about how power can be procured to meet those requirements. So how to ensure that your renewable power can be matched on either an hourly or a monthly level, and whether or not you can rely on grid electricity or not. But in addition to sort of thinking about that, most projects at the moment, or all projects at the moment, are very dependent on bilateral contracts between producers and off-takers. There is no hydrogen network, as we've alluded to. And within those bilateral contracts, developers then are having to think very carefully about the offtake profile that their off-taker actually needs to see, which in the case of a lot of industrial processors is more of a baseload profile. So sort of thinking about how power procurement agreements can be put together to ensure that hydrogen can be produced at or close to baseload while still meeting those low carbon or renewable hydrogen standards is very critical to bidders. So sort of thinking about what renewable generation profiles look like and the impact on hydrogen production load factors, and therefore what the requirements for storage of either electrons or hydrogen be able to ensure that off-taker need can be met is one of the critical factors we've been looking at. And of course, what the potential impact on costs are. And generally, there's a lot of different business models that we can think about here. And it's important to think about what are the most competitive ways of doing this to ensure that successful bids can be put together.
Great. Thanks a lot for taking us through that, Emma. For the final section, I'd like to take a look towards the future more broadly. Johanna, what are your main takeaways or learnings from the auctions for the next auction rounds?
Well, first of all, I think it's really encouraging to see that this nascent hydrogen market is ready for an instrument like an auction, which is geared at scale up and no longer pilot projects. And what's good to see is that banks are ready too. So the auction proposes to pay only after entry into operation. That means the construction risk and the pre-financing, so the financing before any subsidy comes in, has to be taken with private capital. And all of these bidders have shown that both banks and companies rolling this onto their balance sheet are ready to do so. I think that's a really positive sign. Second takeaway for me is that really having competition on the European level rather than on national levels is really beneficial, both for competition, but also for European market coherence. And now what we need to focus on is really infrastructure. I think these are my top two. Yeah.
So when will the next auction take place? And are there any things that you already know you will change for the second auction?
So the next auction will take place towards the end of this year. There's no specific date yet, but you can expect that it's around the same time as it was last year. The budget is not yet determined, but we will announce that latest by this summer. And we can expect, given that the competition was really positive, that it will be slightly higher than the budget in this round. What is the process to adjusting these T&Cs? This was a pilot, and we're all learning from this pilot experience. And we don't just want to learn from it within closed doors in the Commission. We really want to get industry feedback again. So what we've done is we've published draft T&Cs already now. This is basically our proposed changes for the next round. They're on our website, and stakeholders can give us feedback until the 12th of June, which is when we have another stakeholder meeting to discuss the industry's feedback on our proposal for changes. On a big picture view, I think the three things we propose to change is we can afford to lower the ceiling price. We can afford to shorten the maximum time to become operational so that these projects come online earlier. And we will probably be asking for a higher completion bond than in this round. And then something that will also benefit applicants is we're really working to provide templates for all of these qualification strategies. So in the last round, projects had to come up with their own format for a power sourcing strategy, an electrolyzer procurement strategy, etc. We think we will make this process even easier and quicker if we provide templates where we clearly explain to bidders what should be in there, what doesn't have to be in there, so they don't have to guess. Bit of a service mentality here.
Easier for both sides, for the bidders and for you when you evaluate the bids.
Exactly.
That makes sense. Emma, any additional areas for reform that you see?
I mean, from my perspective, I think the reforms that are being suggested do seem very reasonable in light of the results. I guess I don't want to sort of end this on a pessimistic note, as the scheme has clearly been extremely successful. But I think the only thing that I'm looking at and thinking about is the REPowerEU 2030 targets and the level of projects that we're hoping to see online by then. And just how to think about the level of support that's being given in the auctions, and particularly the level of price support that's emerging in relation to that, and whether we really can bring enough projects online at this level of price support in order to meet those targets. But clearly, as I've said, hugely successful so far. So I'm possibly being a bit too pessimistic there.
That's an excellent pitch for the Innovation Fund and more money for the Innovation Fund. I'm turning this into a positive direction now. So yes, I agree. In terms of the magnitude of the targets, the funding volume that can come just from the Innovation Fund and this funding instrument is limited. That's true. But I think on the other hand, it can really contribute to kicking off more market transparency, market formation, and hopefully leveraging some more national resources through this instrument as well. Because indeed, on the European level, we don't have enough European resources to be able to support the magnitude of the hydrogen targets, and the Innovation Fund remains the Innovation Fund. We're not the Hydrogen Fund. So we support a whole lot of other clean technologies, steel, chemicals, cement, CCUS, you name it. So yeah, takeaway, European competition is positive, and maybe we should channel some more resources in that direction too.
Thank you for that pitch, Johanna, and I think that's a great note to end on. Thank you to our listeners for dialing in. I hope you found this as fascinating as I did. Once again, big congrats to you, Johanna, on this very successful first auction. And of course, a big thank you to both Johanna and Emma for taking time out of their very busy schedules to join us on Energy Unplugged. Bye-bye.
That was Hanns Koenig, Aurora's Managing Director for Central Europe, talking to Johanna Schiele, Policy Officer at the EU Commission, and Emma Woodward, Aurora's European Hydrogen Market Lead. Do keep an eye on our podcast feed for more in-depth conversations with senior members of the energy industry. The best way to do this is to follow or subscribe to the podcast via whatever platform you use.